Fundstrat's Tom Lee says a more risk-on environment is going to start either this week or next. He is with us right now once again. Tom, good to see you again.
Great to see you, Scott.
Why is this about to happen, Tom?
I think the principal reason is we're finally getting some visibility that the Delta variant is rolling over in the UK. And I know it might sound strange to be talking about why the UK matters, but as you know, the Delta variant went parabolic there first in early June. It lasted for 45 days. That country has a vaccination rate similar to the US, and I think really demographically similar. And it looks like Delta doesn't just run through the whole country, it finally hits an endpoint. So 45 days later, which was July 17th, it's rolling over. I think that's going to mark the bottom for this whole risk-on fear. And that's why we think epicenter stocks really ignite either this week or next week.
Okay, so JP Morgan just moments ago was talking about Delta not a serious threat to growth. Goldman's David Kostin last night poses a minimal risk, he says. I mean, is that what the market is showing you today, at least for starters, Tom? It's sniffing out the exact UK data that you just referenced?
Yeah, it's interesting because if you did an overlay of the UK and even some of the Wiggles, the case trends, that really was the inverse of epicenter stocks. But it makes sense because the Delta variant scares people because it evades vaccines. It's 1,000 times greater viral load, and the R naught is like 9. So there's a fear that this would be hard to contain. And as you know, that even feeds into monetary policy. CapEx, I think it's something even businesses had to address in earnings calls. So it's pretty central to sort of the reopening narrative. And that's why I'm personally relieved that there is, a break point, that Delta runs out of people to infect.
Your target remains 4,600, but you just mentioned it plays into central bank policy. If cases are going to roll over here in the next 3 to 4 weeks, doesn't that bring the Fed back on the table to start their taper maybe sooner than people expect? Does that upset your thesis in any way?
Scott, that's certainly a risk. But as you know, Delta is one of only 6 variants that are being studied by the WHO. Another variant of concern is Lambda in Latin America. So I think Delta is sort of a queue of many. And I think there's still going to be central questions about how long vaccinations last before boosters needed. These are all going to be part of the Fed's thinking. So I think compared to where they were in June, there's going to be less reasons for them to feel confident about shifting away from a dovish policy, even if economic data remains robust.
So what do I do, though, with this technology stock question right on the cusp of these huge earnings reports? Are we setting ourselves up, Tom, for another sell on the news because the market is then going to start to rotate back to the cyclical stocks and away from tech?
It's a good question, Scott. Tech is larger in aggregate than the entire epicenter sector. And we know market breadth has been improving. So to me, the second half 10% rally we're picturing includes technology. And there's a ton of laggards there. Amazon, Apple, and even Workday, Visa are up less than the market year to date. I just think part of the thinking for large cap investors in the second half is whatever's not up 25% for the full year, I'm buying because it's going to catch up.
Steve Weiss, you have something for Tom Lee?
I do, Tom. I think you're right on your analysis on the markets become more comfortable with Delta. I just think your timing is a little late. It'll continue, but that's exactly what we saw last week. Delta took the market down on Monday, and then we got all the news, and people started thinking about it and saying, yes, it's much more contagious, but the impact that it has on the economy, any economy, is going to be absolutely minimal because of the vaccination rates, number one, and number two, because those that do get it are generally getting asymptomatic. Again, if you're vaccinated, the breakthrough I'm talking about, infections, they're asymptomatic. There's nothing there. And that given where the economic strength is in this country, those are the highly vaccinated areas. So my point is, that's why the market rallied for 4 days, and such a great rally after Delta took it down on Monday.
Steve, if you think this rally that's a Delta relief rally lasts 4 days, maybe you're right. I remember in early June, you told me I was late for upgrading FANG early June. It's been up almost 15% since. So I think it's a relative
Yes,
word.
but it was up a lot. But Tom, yes, it's up 15% then, but look at the move prior to that.
Right, but Tom,
So it was up a lot more than
Tom,
that
Steve,
fire.
Tom's suggesting that he's not late. So what? He didn't have. You don't have to time everything
No, I'd say
absolutely perfectly. I mean,
right,
okay. So if he's 5 days late, I mean, if you want to score it like that. But his point is that there's going to be a huge runway ahead, almost 200 S&P points, and a lot of that is going to be driven by the cyclical so-called epicenter stocks in which he claimed. Now, I'm sorry for jumping in there, Tom. I don't need to put words in your own mouth. Right. You can come back at Weiss in your own right, and I'll hand you the baton right now to do just that. But I think that's what you're saying.
Yes, I agree, Scott. You know, the relief that we expect the market to have if the Delta variant has an endpoint is going to last a long time because, you know, the anxiety's been building for 45 days. We have clients, Zooms. I think the central question was always, when is Delta going to end? Is this going to make the vaccine effort a failure? You know, what's the next therapeutic? It was creating a ton of anxiety. I don't think it's relieved after 5 days of rally. I think it's going to last months, you know, really into year end.
And Steve, Jim Cramer tweeting just a few moments ago, it sort of plays on this same theme. Well, not sort of, I think it really does. If COVID peaks, he says, you're going to want to own everything except utilities and consumer packaged goods. You agree with that, Steve?
Yeah, look at the liquidity in the market. Again, I don't think that's new news, right? And, you know, look, Tom does phenomenal work. Jim does good work. And I say, welcome to my point of view. So that's what will happen.
No, but part of the
no
point,
secrets there.
Steve, part of the
depends
point,
where you are.
Part of the point I think that both gentlemen are making is that the market is still underestimating the upside once you get past the Delta variant fears. I think if Jim was sitting here, he would say just that. Right. It sounds like that's more of what we're saying here. Not like we get it, but we don't get it enough.
Right. Well, let's go to a very important point that Tom made, which is on the booster shots and the variants. The variants are going to keep coming. And right now, the mRNA vaccines, forget about J&J, forget about AstraZeneca, they're ineffective. If you have a choice, you get the mRNA vaccines. And they are working against the variants. We see information coming out of Israel, which is months ahead of us in terms of the vaccine, Pfizer vaccine. And they're saying that in people 65 and older, you will need a booster. You will need a booster here. So then the question is, what's the uptake on the booster, and will that be a worry for the market? So that could be. And I think that's a great point that Tom makes about that. That's why you still want that wall of worry in the market, because if you get that euphoric, COVID is done, it's over, bang, then you get a blow-off rally, and then, hey, then we're going to rest and retreat for a while. So that's why I'm positive on the market, because I think there's always that apprehension.
Tom?
And liquidity.
Tom, I'll let you respond to that, and then Brenda has a question for you.
Yeah, I agree with Steve. You know, I think there's still plenty to worry about, you know, especially because much of the world doesn't have vaccine penetration. So they have to resort to blunt instruments like shutdowns. So I think the market will have plenty to worry about. But as you know, eventually it leads to a synchronized global recovery, maybe 2022, and that's going to extend the cycle.
You also think, Tom, that stocks like, and you mentioned these specifically, that Amazon, Visa, Apple have the potential to rally another 20% from here?
Yeah, easily, because, you know, these are important brand names. They're going to have great growth this year. Their valuations are reasonable. And if there's broad market breadth and tech really has a bid, which we expect because I think rates are behaving, that's going to be a great environment to own tech and FANG into year end.
Yeah, that's kind of like the Jim Cramer thing, right? If you get past this, you own everything but utilities and consumer packaged goods, right? I mean, rates are low. You're going to continue to want to own tech. If the coast is clear, so to speak, you know, on Delta, then you want to own all those epicenter names too. Brenda, what you got?
Tom, I'm wondering, what do you think of areas outside of large cap, particularly small cap growth stocks that had a great year last year, but they've really lagged this year, up less than 5%? Do you think there's opportunity there heading into the second half of the year?
Yeah, I like small caps. You know, they've got high beta to cyclicals, and they do trade really closely to credit, especially triple C and international stocks. And I think when you look at the linkages, in the last 45 days, 2 of the 3 have been tough, right? Because credit hasn't really rallied at CCC levels. And, I think economic visibility weakened. I think all of this is reversing. So IWM and small caps should do better than the S&P in the second half. So something better than 10%.
Hey, Tom, if Kramer says stay away from utilities and consumer packaged goods, what do you say stay away from?
Yeah, I'd actually say I agree, because we were taking a look at this. Utilities don't look great. Consumer staples don't look great. I think I'm on the cusp. I'm not sure what to make of real estate because it's been such a great performer year to date, but actually there's been some relative weakening in the past month. So I might even actually throw in REITs, and I sound contradictory because I'm kind of in a pro-reflation, pro-asset-based trade, but I think it's just that the cap rates have gotten so low in real estate that it's tough.
You've had a nice move for certain.
Yeah.
Farmer Jim for Tom Lee.
Yeah. Hey, Tom, always good to have you on the show. And I think I'm in pretty much lockstep with you, particularly on the FANG and reopening trades. One thing I was looking at this morning, and I'll tell you, it caused me just a little bit of concern. I'd love your take on it, is the growth rate projected in earnings for next year over this year has declined from 17% at the beginning of the year to 10% at the beginning of the year. Now, let's be honest. Both sets of number, 21 and 22, have shot up. It's just that obviously some growth has been pulled forward into this year. And when I look at that 10% growth rate and I compare it to the multiple on the market of 21, does that PEG ratio of 2.1 cause you any concern, or how do you feel about it?
It's a great question, Jim. So if I assumed consensus was right and 10% earnings growth, a PEG ratio of 2 is actually appropriate, because even if growth rates were 7, actually, I would think that the PEG ratio would actually be higher. I know it sounds strange, but PEG actually goes higher as you get towards single digits. But I think 2022 EPS estimates are grossly low. Most analysts are still only forecasting cyclical stocks to get to 2019 margin levels. I think it's going to be more appropriate to think of cyclicals having all-time high in margins because of all this cost cutting. Plus, they've gone asset light and re-engineered their processes. And then on the net income margin side, I think cost of debt is so low that I think you're going to see eye-popping profit margins next year. So I think S&P earnings could be well above 240, 250.
When does the Fed start to take some of the accommodation away, Tom? And how's the market really going to react?
Scott, it's a good question, and I'm not a great Fed forecaster.
Well, you're forecasting everything else, so let's just go there.
Yeah, I think that they're going to err on the side of caution because COVID is not being eradicated by vaccinations. The real solution is going to be therapeutics, or everyone catches COVID. And I think that's the reason the Fed will actually have a dovish tilt. So I think you're still talking 2023.
And the market will be fine whenever it happens, or does that sort of end this current iteration of the party?
Well, something that our team, our data science team led by Tireless Ken's working on is really examining negative rate regimes, which, by the way, is about 25% of all times in history. So it's a pretty extended period of negative real rates. Negative real rate environment, assets like real estate and equities do extraordinarily well. So I think this is a time when stocks may outperform people's expectations for quite a long time.
That's a great place to leave it. Tom Lee, appreciate it. As always, we'll talk to you again soon.
Thanks.